So, what if I told you that a single accounting rule just flipped a multi-trillion-dollar global industry completely on its head? Yeah, no joke. It's called IFRS 17. And trust me, it's about way more than just numbers. This thing is a total revolution in financial transparency for insurance companies everywhere. So let's break down what it is, and more importantly, why you should care. Okay, so to really get this, you have to understand the core problem that insurance accounting has always wrestled with. I mean, think about it. An insurance policy isn't like selling a cup of coffee, right? It's a promise that could last for 30, maybe even 50 years. And it's all based on stuff that hasn't even happened yet. For decades, just trying to put a clear, solid number on that promise, it's been a massive, massive challenge. All right, so here's how we're going to tackle this. First, we'll look at the old, kind of messy accounting problem. Then, we'll introduce the solution, IFRS 17. After that, we'll dive into the nitty-gritty of how it actually works, see how it completely redefines profit, and then tie it all together with why this huge shift matters to, well, everyone. Okay, first up, the old accounting problem. Let's set the stage, because to really get why IFRS 17 is such a big deal, you have to know what it replaced. So the old world ran on something called IFRS 4, and honestly, it was really just a temporary patch, a stopgap. Imagine you're trying to compare two giant companies, but one reports its numbers in, say, French, and the other in German, and they're both using totally different rulebooks. That's kind of what it was like. This patchwork system made it almost impossible for an investor to look at two insurers and know for sure which one was actually performing better. It was a huge headache for the entire market. So after more than a decade in the works, the International Accounting Standards Board finally rolled out a solution, IFRS 17. The big idea here was to create one single, comprehensive, global standard for everybody to play by. And the IFRS Foundation put its objective out there very clearly. They said, the goal is to ensure that an entity provides relevant information that faithfully represents those contracts. Okay, so what does that actually mean in plain English? Basically, the goal was to make companies tell the true economic story of their promises and their performance, without all the confusing variations we saw before.
When you boil it all down, IFRS 17 is really about one thing: transparency. It's designed to give everyone, from the biggest investors all the way down to the companies themselves, a clear, consistent window into the real financial health of the business.
So how in the world does it actually do that? Well, at the very heart of IFRS 17 is a new method called the General Measurement Model. And the absolute easiest way to get your head around it is to think of it as three essential building blocks. All right, block number one is called fulfillment cash flows. You can think of these as the actual bricks in our wall. It's the insurer's best guess of all the money they expect to pay out in claims, minus all the premiums they expect to collect. This is the absolute core calculation, the foundation of their future promise. Next up, block number two, the risk adjustment. Now, if the cash flows are the bricks, this is the mortar that holds them all together. Insurance is all about uncertainty, right? You never know exactly what's going to happen. So this block is basically a financial cushion. It's the extra amount the company sets aside just to cover the risk that future claims turn out to be way worse than they originally thought. And then we have the third, and honestly, the most revolutionary piece, the contractual service margin, or the CSM. This represents the total profit an insurer expects to make from a bunch of policies over their entire lifetime. But, and this is the game-changing part, they are not allowed to recognize all that profit on day one when they sell the policy. And you know, this whole idea of the CSM just completely changes the game for how insurers report their profit. That old practice of booking a huge profit the second a policy was sold, yeah, that's over. Gone. Say, under IFRS 17, profit is now earned over time. As a service, the insurance coverage is actually provided. So that big chunk of expected profit, the CSM, it sits on the books as a liability. And then each year, as the company provides coverage, a little piece of it gets released into the profit statement. This forces a much smoother and frankly more realistic picture of how an insurer is creating value over the long haul. Okay, so that makes a lot of sense for contracts that are gonna make money. But what about the flip side? What happens when an insurer sells a policy that they know right from the get-go is probably going to be a money loser? Well, IFRS 17 has a very direct, no-nonsense answer for this. These are called onerous contracts. And the rule is simple and it is strict. If your expected costs are higher than your expected premiums, you have to recognize that entire expected loss immediately, right then and there. No more kicking the can down the road or just hoping things get better. It's all about financial honesty right up front. So, after all that technical detail, let's just zoom out for a second. Why does any of this really matter to someone who isn't an accountant? I mean, what's the big picture, real-world impact here?
Look, for the insurance companies themselves, getting this done has been a massive, massive project. But for investors, for the market, the benefits are crystal clear. For the first time, we can get a true apples-to-apples comparison between companies anywhere in the world. We see a more realistic picture of how profits are actually earned over time, not just in one big lump. And we get a much, much clearer picture of the risks they're taking on. The whole thing is designed to create a more transparent and understandable industry for everyone.
At the end of the day, IFRS 17 really forces a whole new level of honesty about how these companies make or lose money. And that leaves us with a final, really critical thought. Now that the accounting is so much clearer, how is it going to change the insurance industry itself? Will this transparency push companies to design better products, to price risk more accurately, or maybe even to walk away from business lines that are just always unprofitable? That is the big question for the years ahead.